It is nice having you. We have a lot to get to today because we're going to be talking about some of the risks that we're seeing around the world, as well as how we can capitalize on some of those with changes in your portfolio. Then we're going to dive into some advanced planning that is specific to stocks that you may have and ways we can be mitigating risk with those stocks. And then we'll be wrapping up with our second opinion service. So yes, we have a lot to get to today, and I'm really looking forward to our time together. So let's dive in. Number 1, economic and stock market risks. Things are changing very rapidly on an economic front. When we take a look at the global economy, we have been in this global manufacturing and industrial recession for almost 2 years now. Now that's not exactly what you've been hearing in the media, but what we're starting to see is that we're starting to come out of this and we're going into a lead to scenario. So this is where we have the Lion's Wealth Economic Activity and Development Stage 2. And what this really means is that we are coming out of an environment where we've seen little growth in our economy, but we've seen inflation. Now yes, inflation has been coming down, but it's starting to pick up a little bit more recently. Now, what we're starting to see though is that this lead to scenario is where we actually start to see growth in not only our economy, but many of the economies around the world. So this is an incredible opportunity because after 2 years, we're starting to see really that not only in the US here, but also in Asia, in Western Europe, all of these different places are starting to come into this collective lead to stage. So what this means though, is that when we take a look at scenarios, when we take a look at different, what we call rates of change with respect to not only assets, but countries, we can actually start to determine pretty nicely then where we're going with the economy in general. So right now, when we take a look at what we call the rate of change, we're coming into an environment that we are seeing positive growth for economies and potential for a little inflation to start picking up. Now that may not be a bad thing because right now when we come into this stage, that can actually produce a lot of growth that can be very helpful and sustainable for the world's economy. Now, as an example, let's take a look at India. They have been doing an incredibly well, I should say, with their economy over the last number of months. But when we start to add in places like South Korea, that have gone into a lead 1 scenario where we have growth in the economy with little to no inflation. Well, then we can start to add in the US here as well. So we have momentum type stocks, we have housing type stocks, we have growth stocks, we have insurances and the likes. So we have many different areas that have been working really well in this environment of a little bit of inflation and some growth. Now, yes, we are coming into an environment, like I said, that we have global growth starting to happen. And this is not a prediction. This is just what we call rate of change. So we don't exactly know where the S&P 500 or the Dow Jones or any of these places are going to be trading. But what we do know, when we come into this environment, when we come into a global macro environment where we see this huge surge of growth happening on a world scale, that tends to grow assets, it tends to grow housing, it tends to grow investments into the stock market, and that is what we're looking for. So it's not a prediction, but what it is saying when we take a look at the math, this is going to be potentially a very good opportunity for us. Number 2, portfolio changes. We're going to continue with a number of the opportunities that we've had over the last couple of weeks here. Now, those opportunities have really been with respect to energy sectors, as well as value, including financials and even what we call consumer staples. Think toothpaste. Well, there's a lot of opportunities that we have here with respect to those environments, but also with other countries. So we've been already highlighting the fact that many countries may be coming into this lead to scenario that they're growing their economy. Well, if that happens, the ones you're going to actually see really come into this quickly is going to be Asian countries, because right now they are tied to China. And China has been really leading the industry with respect to 2 years of this manufacturing just slump that they've been in. And if they actually start to pick up, if they start to grow, then you're going to see other Asian countries start to do the same as well. So we actually are starting to see some really great environments for, say, South Korea to grow, whether it's the Philippines or other countries there as well. But then let's not forget Western Europe as well. And right now, Germany is going to be leading the pack of many of those different growth areas in ways that their country is going to help really bring up the entirety of the European Union. Well, if that's the case, then we can start to see a lot of different environments where we can see countries in Europe start to grow as well. So if we focus on some of those areas with emerging markets, Asian markets, even developed markets with respect to Europe, that's a great way to diversify our portfolio as well. Because yes, there have been great ways that the US has been working, but when we add in some of the others, we can really start to see that this is going to be a global phenomenon that we're coming into. Now, I'm not sitting here saying that we're not going to be seeing ups and downs and volatility. We still will see that. That's going to be a given. What I am saying is that when we see positive momentum with economies, that generally means assets follow suit. So we have great opportunities to come, and those changes that I was highlighting, especially with some of the ways that we're looking to go international, will actually help to diversify the portfolio overall. Number 3, wealth management and advanced planning. There are many different ways to protect yourself in case stock that you own goes down in value. Selling the stock is a good example. There is a however. What if you have a tax impact because you sold the stock? Well, that is where a protective put may be a good option for you. You see, what this does is actually provides some downside protection. So if the stock goes down in price, you may actually gain in value with that put. So that will all really offset losses from the stock you have if it's going down in price. Now, what this will do then is really provide that layer of protection, and it's also a way that you can still own the stock and reduce overall taxes while waiting for the stock to come back up in value. So this is something that you can look into a little bit more just to see if it's going to be right for you, because it's really good for uncertain times with your stocks. And right now, there are some companies that are not doing very well. Take Apple, for example. Apple has been doing very well over the last number of years, but they've had some hardships recently. Well, this may be an opportunity to protect the gains that you have without selling, without harvesting any of those really long-term capital gains or even short-term capital gains that you have and having a big tax bill because of that. But what we could do then is write a protective put, and then this will allow for the value of the stock to come down, but you may not really feel the impact or the pain nearly as much. That's what a protective put is good for. So there's many different strategies, like I said, on how to do this, your level of exposure, and ways that the stock can actually still grow even with this put on. But what this will do then, like I said, is help to reduce taxes. And yes, there may be some taxes with the puts if you gain in price over time, but that may be significantly less than if you had sold the stock, and provide potential for future gains. So take a look at this to see if this may be the right opportunity for you and your stock. Number 4, our second opinion service. Our second opinion service is really designed for you, your coworkers, your friends, and those you care about, really to have a stress test and a second opinion on their overall wealth plan. Now, what this will do is bring you through a series of meetings, a discovery meeting and an analysis meeting. And what we will do then is determine where you're at today, where you want to go in the future, and then see if there are any gaps that exist. Now, if there are gaps in your overall plan, we'll set up a plan of how you can be working forward and through those gaps to make sure you close them and have a better wealth plan on the other side. That is what the second opinion service is for. So if you would like to have a second opinion service, please let us know. We'd be happy to meet with you, discuss those gaps that exist, and ways that you can be working to improve upon them. As always, we are here to help you with any aspect of your overall wealth plan and investment plan. Feel free to reach out and we'd be happy to set up a 15-minute consultation just to get to know you and where you want to go. So please feel free to reach out by clicking the link below this video. With that, take care.